Hi, my name's Gavin Richardson, I'm Head of Sales here at Mortgages for Business, and I'm with Paul Keddy, our resident expert in all things commercial and development finance. So we're going to talk a little bit today about some opportunities that are in the market for purchasing properties that currently aren't fit for buy-to-let mortgage for a variety of reasons, and just see what the options are in financing those. So Paul, first of all, it's probably worth explaining to our customers the different options available, and maybe primarily the difference between a sort of light refurb and a heavy refurb, because that seems to be an area that's quite grey in the market at the moment.
It is, yes, and it's quite a distinction between the funding lines between soft and a heavy refurb. So a light refurb is a very basic sort of like touching up the property. So you're going to sort of do a bit of replastering, a new bathroom, a new kitchen, and maybe the heating. So something like that, which doesn't cause any structural work to be needed, no building regs or anything like in that respect. So it's very light. It doesn't normally cost more than 15 to 20% of the value of the property.
Right, so good parameters.
So it's good. And a heavy refurb is where you've got maybe putting on an extension. You might need a little bit of planning, building regs come into play. And you know, the cost could be up to 30% of the property. So that's really how it's distinguished between the two.
Okay, and you've got a lender in your toolkit that will lend on both light and refurb?
Yes, we have. Yes,
light
we have.
Heavy refurb, yep.
That's right, yes. Yeah, we have. And the way they lend is they lend sort of 85% of the value of the property on the purchase.
Okay.
So that's quite a sizable
lending
value, yes. But you have to bear in mind that they don't actually lend for the costs of the refurb. So whilst they're lending 85%, they'll roll up interest during the period of the loan. So in cash terms, it tends to mean you get 80% of the value. So if you're buying something, let's use round figures, 100,000, you'll get £80,000 towards the purchase. You would then need to spend 20,000 to complete the purchase, and then you'll need to spend monies on the works and any professional costs you have.
So they won't lend the cost of the works if you haven't got it already. They won't add that to it in any way.
No, they won't. No. So it's sort of, you know, a lovely product because it frees you up. You haven't got someone looking over your shoulder all the time. So they lend quite a bit on the original purchase.
Right.
But they need to be comfortable you have the money to complete the works.
Okay. So whereas in a more traditional sort of development finance deal, you may have the lender insisting that inspectors come around and check each stage of the work is completed satisfactorily. With this type of deal, not required.
That's not required. So you haven't got sort of that hand on your shoulder looking at everything that's going on. So that's quite a relief.
So is this only available to experienced developers?
Well, yes and no.
Okay.
That's a great answer, isn't it? Yeah. So light refurbishments, as I said, it's sort of cosmetic as such. So the lenders are taking a pragmatic view, and you don't need to have experience in that respect. So you can still secure that 85% without any experience. Heavy refurb, as you can imagine, you've got planning and you've got building regs. So they would like to see some experience, or at least a skill set. So you may be a carpenter or in construction in some way, in some form, a bricklayer. As long as you've got something like that in your set of tools, your skill sets, they will help.
But you don't necessarily have had to done this before.
Not necessarily, no.
Okay, useful. And costing wise, is it kind of a lot more expensive than a traditional sort of bridging deal, or how does it actually?
Well, with regard to sort of the cost, it is less costly than, you know, your traditional bridging deal where, let's say, 1% interest is charged. We're looking at, on the light refurbishment, if you go all the way out to the top, i.e. 85%, you're looking at 0.8% per month, okay? And then if you go to the heavy refurb, you're looking at 0.9. So that's not too bad. The arrangement fee is very similar to bridging. It's sort of 2%.
Yeah.
So
not more costly really than bridging in the scheme of things. That's quite well.
No, it's not more costly, and you're getting more out than you normally on the, because normally bridging you'll get 75%, net 70, so you're getting more out. So you can say that extra little bit is your funding towards your development as such.
Helps with cash flow a bit more.
It helps with cash flow, yes.
Fantastic. And what are lenders looking for in particular? Anything they should be, or customers should be avoiding?
Yes, there's certain properties it's good to avoid. Listed buildings, sort of grade 2, definitely grade 1. And obviously if there is some, subsidence you feel there, some massive cracks, it's good just to step back.
Yeah.
Because you never know quite what you're going to unearth.
Yeah, fantastic. And what about in terms of, we see quite a lot of clients looking at maybe an old office block and potentially converting it into flats. When there's a change of use in this process, is that something that's considered?
Okay. On this particular product, it will be considered, but you have to have had the council's permission before they lend. So it would fit more likely in the heavy refurb situation, but the council has to give the PD commitment before they lend a penny.
PD, planning development. Yeah.
Permitted development.
Permitted development, great. So I'm not the expert. Okay, fantastic. And does the work need to be completed within a certain time frame?
Yes, there is a sort of time frame you need to look at, because you may recall I mentioned a gross lend and a net lend. The main difference between the two is the interest roll-up, because you're not paying any interest during this period.
Right.
Okay, so they net off the interest from the gross loan. So if you said, I can do this, a light refurb should only take about 3 months. So you say, well, I'll take a loan out for 9 months or 6 months. Then the net amount you get is far higher because there's less interest to take away.
Okay.
Okay. But the maximum term is 18 months, can push it to 2 years if needs be.
Okay. So should give most customers ample time to actually get the
plenty
deal
of
done
time,
and potentially refinanced at the end
Time
of it.
is money on this,
Yeah.
isn't it? So the quicker you do it, the quicker you can refinance.
Fantastic. But it's obviously, you know what you're talking about, Paul, and customers are going to be interested in talking to you. So how do our clients get hold of you directly to talk through these types of deals?
Well, you can sort of give me a call on my direct line, which is 01732 471 655, or just ping me an email. My email address is on the website, so that'd be great.
Okay, so just very quick, it's paulk@mortgagesforbusiness.co.uk, because all my questions go to Paul anyway. Great, thank you very much, Paul. Thanks for your time. So, like I said, it's a fairly unique product. It's in the marketplace. Paul is our expert at it. So, if you've got any questions, please feel free to get hold of him, and we look forward to helping you. Thanks very much.
Lovely, thank you.